traders from across the globe, and welcome to the 807th edition of Short-Term Trading Live with Oscar. Thank you so much for tuning in. Traders, 806 other videos about technical analysis and how to gauge future market movement off of charts. My name is Oscar Carboni, and I've come out of the pits on Wall Street to teach you the tips, tricks, and techniques that I learned by the professionals down in the pits. And I'll tell you right now, there's almost no better people to learn from than the pros that used to rule the pits. And I share this information with you as I do almost every evening. And this video is being filmed for trading on Sunday through Monday. That would be December 12th, 2011. Traders, what's on the board? Well, we have the ES and the NQ above the 200 bar moving average, both of them in bull flags. The opposite side of that, we've got the dollar index in a bear flag after respecting a double top. Interesting. Traders, as we know, futures trading is extremely risky and can cause substantial financial loss. Not every technique that you use will work properly. It will not work every time. If you do not have risk capital to lose, and if you do not understand the risks behind trading, you certainly shouldn't be trading futures. But for you traders that understand, again, the NQ and the ES, NASDAQ and S&P on daily bar charts are above the 200 bar moving average, which has been giving us the flip-flop all along, and both in bull flags. Traders, you gotta love it. You know the difference between a bull and bear flag, right? The bull flag generally is a market that starts to move up, 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 and that looks like the flagpole. Then it comes down and spends some time consolidating before going up again. That's the flag, and it's a bullish flag, right? The opposite is a bear flag. It does this, it starts to come down a little, right, down, down, down. Then it goes up into a sideways consolidation before dropping lower. This is your bear flag. So we will be looking at the bull and bear flags, the bull flags in the ES and the NASDAQ, the bear flag that's in the dollar index. And I think that's probably enough to take U.S. indices higher on Sunday through Monday and push the dollar index lower. That's what we're expecting. Let me show you what that looks like on charts. If you like the analysis that I'm about to show you and the way we gauge markets, simply come on down to livewithoscar.com, jump into my free trading room, and allow me to help you become a better analyst, which should in turn make you a much better trader. With no further ado, let's go look at some charts. Okay, traders, for trading Sunday night through Monday, that would be 12/12/2011. As you can see, the emini S&P daily bar chart, it is the March contract, right? ESH12, no longer trading December. We trade March now. As you can see, traders, there was major resistance illustrated by this blue line. The market ran up, 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 put in the resistance spot, ran up again, ran up again. So as it was making highs, it creates a resistance line, right? That line was bested right here in the form of a flag, which I'll show you in a moment, but we are still holding the 200 bar moving average right here. The market settled above it on Friday, has gone through it a couple of times, but keeps settling above it. The fact that we are above it now keeps us bullish. We are inside of this parallel channel and respecting it. That keeps us bullish. So above the 200 bar, inside of the channel, looks pretty good for me so far. Then, traders, look at this next picture. You have the NASDAQ, right? The secondary leader of U.S. indices behind the transportation average. Well, it's in a bull flag itself. It's above the 200 bar moving average. In fact, it's never breached it. And it looks to me like it's going to want to break out of this bull flag shortly. So you have the NASDAQ in a bull flag, stays above the 200 bar moving average for quite some time now, and looks to me like it's going to want to move higher. Then, of course, traders, let's go take a look at the exact opposite. The dollar index. You remember the double top that we talked about 2 weeks ago and last week? When we got here, I put this chart before you and said, looks to me like it's a double top. From there, it should go down. Well, we have come down since we showed you this chart last, and now we've created a bear flag. So, dollar index, been a real leader of all markets lately. So, dollar is king lately, right? So the DX we know is king. The dollar index rallies up, puts in the double top, breaks down into a bear flag, and if the dollar is going down, almost everything else goes up. Remember, I've shown you this many times, but if you had a little teeter-totter right here, and you had dollars on one side, and you had stocks on the other, if dollars went up, the stocks would go down, but the opposite is also true. Of course, if you have your teeter-totter when your dollars are here, and your stocks are here, if your dollar goes down, the stocks go up. That's the way that works. So, if you're in a bear flag in dollars and a bull flag in the stock market, it makes perfect sense that the dollar likely should continue inside of this flag until it breaks to the downside. Now, looking at dollar index formations, we also look at the indicators. You have stochastics pushing straight down on the dollar index, and you have one of the big booming trending indicators, MACD, moving average convergence divergence, also pushing straight down, showing us a bearish look for the dollar index, which should in turn be a bullish look for the E-mini S&P. Traders, pull your own charts, do your own homework. Make sure you look at your indicators, look for the flags in the US indices on the bullish side, and look for your bear flag in the dollar index. So traders, you've seen the charts, and there's my technical argument for why we have the green OMNI on the board for Monday, Sunday through Monday. All right, traders, remember, the bear flag, when you have a market that was running down, 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 and then heads up in a sideways consolidation, this is considered the bear flag pole. And then, of course, the sideways consolidation is your flag, and what you'd expect next is a down move, right? Well, you have your bull flag right here. The ES, let's say it ran up and it comes down in the sideways consolidation. You expect the upside, and this run up is the flagpole. So there's your flagpole, there's your flag. That should be your next direction. So you have ES in the bull flag. You have dollar index in the bear flag. That absolutely points to a bullish OMNI for trading on Monday in the indices. And that's what I am going to do, at least at the onset of trading. We will be looking for the upside in U.S. indices. Now, traders, we've seen a great deal of volatility lately where you got to start the day off buying and end up selling at the end of the day, and vice versa. So I'm here to say we're sticking with the upside. We expect the upside. We're going to start off with the upside, but I can't guarantee nothing past that. The volatility has been crazy. I will say this. As December creeps along, volatility will get greater, volume will get thinner, and Oscar and the OMNI will be out of here. As soon as volume starts to get a little too thin, we shut down for the year. We're trading now. We'll play it day by day. I'll let you know when it's my last day, but it is coming soon. I do not trade through the month of December past the first couple of weeks. Traders, we have this week together. Let's see what we got. Looking for the upside on Monday. That is December 12th, 2011. Always remember, do your own analysis. Never listen to anybody. I could be some kook on the internet who stands there and shows you all this great stuff, but I might be a lunatic who escaped from a loony bin, right? So do your own homework. Do your own analysis. Never listen to anybody else until you've compared it to your own studies. The other thing you need to do is keep your emotions out of trading. One of the best things you can do to help yourselves with that is to say this to you every morning, every afternoon, every evening, and you know what that is. Stop soaring! Emotions are out! Yeah. Video number 807. Futures trading is risky and can cause substantial financial loss. We do not claim or guarantee that you will profit from the information provided.